Hello and welcome to NDTV Profit. You're watching IPO Adda, and the company in focus today is Suraj Estate Developers. It's a central Mumbai-based real estate company which is into development of residential and commercial properties and also in tenant resettlement in that area. And joining me is Mr. Rajan Thomas, who's the chairman and managing director of the company, and Rahul Thomas, who's the director of the company. The company's IPO is opening on December 18th, closes on December 28th, price between 340 to 360 rupees a share. It's a fresh issue of 400 crores, and the company is valued at nearly 1600 crores at the upper end of the price band. Gentlemen, thank you very much for joining us on NDTV Profit. My question to you, Mr. Rajan Thomas, you're raising 400 crores in fresh issue. What is the purpose of this fundraise?
It's partly for retiring high-cost debt and partly for launching our existing sites to meet the cost of launching the existing sites. We have about 16 new sites which have 16 new sites which we have acquired sitting on our books, and we will be using these funds partly for launching those sites as well.
Rahul, can you give me a sense of what is the kind of debt you are sitting on as of today, and how much of that debt would be retired or repaid?
So currently we have 450 crores in terms of our secured debt, and out of that we plan to repay 285 crores of our secured debt from the IPO proceeds.
Mr. Rajan Thomas, if you can give me a sense of the kind of opportunity that is there in Central Mumbai area, because you are working in Central Mumbai, which includes Parel, Mahim, Prabha Devi, and a little bit of Bandra. So can you give us an idea of the kind of opportunity that is that you're there, because you're a localized player in that market?
Yeah. So basically, you see, this is a very prime area of Mumbai city, as you call it, the island city of Mumbai, where vacant lands are very rare to come by, or if at all they come, they are at very high prices. So the only way to go forward is to engage in redevelopment of very prime properties. So what we essentially do is come into terms with existing tenants, provide them very good quality housing as permitted by the government authorities, MADA and BMC. There are schemes. One of the schemes which we are specialized in is 33(7) of the DC regulations, where we are allowed to give ownership rights and give area of up to 425 square feet to each tenant in lieu of the existing area which they occupy. But if that is 300 and below, we'll get 425. If the area is more than 300, they will get accordingly something like 40% more than the existing area. So the kind of scope we have is tremendous, because there are about 19,000 such assessed properties in island city of Mumbai, of which only 4,000 NOC, 4,000 properties have got NOC for development. So there's untapped potential of up to 15,000 properties. Besides, government has also introduced a new, in the last DCR, there were 30 years and above, properties which are older than 30 years and above, buildings, society buildings, can also go for development. So this you have to do it in a different way by buying TDR from the market and loading it on. And it's also related to the road width and things like that. But there's a tremendous opportunity there. It's a new kind of a window opening up for us. And as we speak, we have dealt with 3 such societies. And going forward, we have many societies who want us to do it. But post IPO, we will definitely be going also in that direction.
Okay. Give me a sense of, when you say that you develop real estate properties, my understanding is that you don't have your own firm that develops it. It's a third-party contractor that does it for you. So is primarily is it fair to say that it's an asset-light model that you're following?
When you say, first of all, most developers outsource the construction work to reputed contractors, because you see the value that we can save by getting engaged in construction activity ourselves is very less. So we opt to appoint very good contractors who can execute these projects. Now, coming to asset light, what is asset light? Asset light is we don't put too much of money upfront in acquiring a land parcel or getting into any development scheme or proposal. So our asset light, one of the asset light is development of society properties, because these properties you typically don't buy, you don't have to pay for land, you have to only engage in getting the consents, and getting all the approvals, buying the TDR, loading. So the investment is relatively less compared to the scheme of things.
So give me a sense, Mr. Thomas. Typically, when you get into a property development or redevelopment, let me put it this way, what is the kind of investment that has to go from you as one of the parties to the joint development?
So I think first let's start with the land cost. So that has to come from your own equity. Secondly,
but in many cases, the society has the land in terms of conveyance, right?
Yes.
Yeah. So if it comes to society development, the kind of money that we have to invest is relatively less. Mostly is related to obtaining buying the TDR, getting the plans approved, and then providing temporary alternate accommodation to the members of society till such time the project starts and it's completed and the new flats are handed over back to the members.
So, is there a
So typically, what the investment would be something like 40% of the overall cost of the project, 30 to 40% upfront,
which will be there, and the remaining would be
how do you by way of sales? Rahul will tell you.
Yeah, so I think construction will be phased out. So it'll be a construction linked milestone which we pay our contractors, and I think that's the same way we get money from the buyers. So what is important to note is cash flow starts from when we get CC and the RERA registration. So once we pass that milestone, I think cash flows come in, and post that obviously we have construction cost, and that's pretty much mainly the cost which we have to incur post the IOD premiums.
Mr. Rajan, just to get a clarification, because when you do a real development project for a society or something, you have to provide the existing tenants flat there. So there is no cash which is coming from the existing tenant. It's only when you bring in the external buyer into the project when it is there. And in many cases, this basically happens over once you go up the floor or beyond a certain tier, that the flats are sold to a higher to the buyers. So, in the interim, how do you finance your projects?
Yeah, it's a nice question. Basically, after we get into terms with society, we typically have to invest money, buy TDR, get the plans approved, etc. And then the tenants, the society members will be shifted. We demolish the existing building, and then we commence the construction and get RERA registration also in place. Only then we can market the project and then open up to the market for getting their sales and sales revenue, etc. Typically at the booking stage we get 20%, and on completion of the plinth another 25%. So we get about 45% of the sale consideration at the plinth stage.
And after that, is that enough to reach out to that level where?
Yeah. Very good question. Again, it depends, to what extent you like to sell your project off. To meet the requirement, even if you sell 50% of the sale component, it will be sufficient to meet the expenditure for the construction.
Typically, what is the kind of margins that you would see in a project?
Well, we have two, as you said, we do two verticals. One of the first vertical is a 33.7 DCR, where the margins are more, but the lead time is also more because we need to obtain consents of tenants. Something like 51% of the tenant consent takes a little time, maybe 6 months, 9 months, sometimes 1 year. So after we have crossed that particular vertical gives us about 40% margin across the life of the project. Okay. Whereas 33.7B, which deals with development of society buildings, there the margin may be 5 or 10% less, but the turnaround time is faster.
Give me a sense of the kind of projects that you have done so far. You've done 42 projects, if I'm not wrong, and 41 of them have been redevelopment. And Mumbai is increasingly getting into the redevelopment mode, and there is a hyper competition in this market. How do you go about managing this competition?
So coming to the projects, we've completed over 42 projects. So we've actually have dealt with a lot of corporates over our journey. We've sold 3 buildings to ICICI Bank, 1 building to National Stock Exchange in the residential side. We've constructed the corporate office for Saraswat Cooperative Bank, again redevelopment where we rehouse 100 tenants at the back, and the sales side is what we sold to Saraswat Bank. We've also done a redevelopment where we've given Clearing Corporation of India Limited their corporate office. where we rehoused about 80 odd tenants and a separate building, and then the sale component was sold to Clearing Corporation of India Limited. So this is of course in the residential and the commercial side. In the luxury category, in the residential space, we're doing two big sites, one called Palette, which is a 50-story tower in Dadar, and another project called Ocean Star, which is a 42-story. So of course, this is has state-of-the-art amenities, and we make sure that the quality of what we're providing the customers are very high-end. So it really kind of competes with the other fellow builders who are in the particular location.
What is
Having said that, the competition, well, we have some other builders also having multiple sites in our area, but there is sufficient property available for everybody, and the market also is quite good. So we don't feel the heat of any competition now. As long as your sites are up and running, people have confidence on your brand, they will put money.
what is the kind of saleable area that you see from these upcoming projects which are under construction?
That'll
And,
be
uh,
point.
yeah,
Yeah,
sorry.
0.75 million is what we have as an upcoming portfolio, and 0.6 million is what we are constructing in terms of carpet area for sale, and 0.6 is what we're developing currently.
Currently, we are doing 13 sites with a total constructible area of 2 million square feet, of which roughly one third, will be available for sale. The rest would be in terms of infrastructure, common areas, and areas to be given to tenants, shared with tenants, etc.
What is the kind of average realization per square feet that you have for this saleable area?
So the last few transactions in the value luxury is what we're doing is around 38 to 42,000. That is the range. In terms of our luxury portfolio, it starts with 47 all the way to 65,000. That would be the range in the luxury portfolio in South Central Mumbai.
Okay, and that is the value at which you're selling, but what would be the realization there, the EBITDA that you're looking on this kind of project?
So, last year we did EBITDA of 151 crores. So, so going forward, of course, we have a good kitty of 0.75 million. So that will be developed in the next 4 to 5 years. So, of course, those revenues will be coming into our.
These are all prime locations like Dadar, Prabhadevi, Maim,
And Bandra.
and Bandra. So Dadar, Prabhadevi, Maim has got a price, attraction or range of 40,000 to 60,000, and Bandra can go from 50 to 70,000 on a very conservative estimate.
I've been looking at your numbers, FY23, 305 crores in top line and 151 crores in EBITDA. In the first half is 102 crores and 46.7 crores in EBITDA. What is the kind of projects which will be completed in this financial year? Will you be able to cross the FY23 top line and EBITDA number? Given
Yes.
given that if I do an annualization, you may be missing the target.
Well, I'll tell you. Last time we did a top sale of 650 crores,
635.
crores of sales. But actual booking is done. We follow a certain percentage completion method, as per which we have booked a sale of
306 as the top line and 151 as the EBITDA.
You can imagine out of 306, our EBITDA is 151. Of course, our PAT is lower because of high interest costs which we incur, because we generally borrow from NBFCs, because banks don't come and participate in the early stages of project. It's only after the project reaches certain proportions, and we have already booked certain sales, and we have a CC in place and RERA registration, that banks are willing to come forward. So this your question whether we will meet the target? Yes, we'll definitely meet the
how do you say that? Because I just want to understand, because you're following the percentage completion methodology, what percentage of your projects are expected to revenue generate or account for revenues in the next half of the year?
So in our ongoing portfolio, we've recently concluded 2 transactions with 2 big institutions. So those institutions will, so those are adding only 2.5 floors each to each of these clients. So because of which we see a good collection, and those projects are going to take only 6 months for completion. So we see a good amount of revenue being recognized from those projects, apart from the 3 new launches we are planning for early next year.
So we have the ongoing residential sites also, all up and running. So we are confident that our sales, targets will be met for 23-24.
Yeah, because pre-sales does not translate into revenues because it's we have to follow accounting norms of
Absolutely.
revenue recognition. So,
Absolutely.
so how much of that recognition is what is expected in the second half? Because that's what my question was.
So I obviously, I mean, as for them, we cannot talk about forward-looking
Forward.
statement, but I can only tell you that we are on track with our revenues and we are trying to surpass our last year's target. And I think we are very confident on getting those numbers.
Keep-
Yeah.
keeping in mind our growth profile for the last 2-3 years, and keeping also in mind that the real estate industry as such is doing pretty well. We don't find any difficulty. We don't envisage any difficulty, at least, to meet the targets, which the same traction what we did earlier, the same percentages can be achieved.
How scalable is this model of yours? Because since you are asset light, you negotiate with the landowners or for societies and then go into development stage. How scalable is it? Because I've been looking at your top line numbers. It's been growing between 10 to 15% last 2-3 years. So my question is that where does scalability come into this model?
Yeah. So today we have 13 sites and we have a pipeline of about 16 sites more, which could keep us busy for the next 4 to 5 years. As we keep executing those sites, we'll be adding newer sites into the kitty. And having said that, we will scale up in two forms. One in terms of numbers, we may take up to 15 sites at any given time. And also we'll be taking larger properties, larger footprints. So, our sale realization and, the revenues, etc., will be increased over the period.
Does it require you to go for short-term funding or fundraise? Because if you're going to increase your projects in the short term, the initial capital which has to be brought in by you, will that require to go up and financing need to go up for that? Is your balance sheet able to handle that kind of short-term capital requirement?
Yeah, see, from the existing portfolio which we have of 13 sites, there's sufficient margin surplus available, which will be achieved and recognized next 24 months. And from whatever because we don't have to add any more land costs, that money can be used as a working capital to execute the next 16 sites which we have on hand. So going forward, our borrowing will be very limited, and it will be at a much lower cost than what we are paying today. Because today the NBFCs help us at the initial stages of site. From the fund raised now, we will be utilizing that for meeting the initial requirements of various sites, and only borrow from banks for the construction finance, which will be at a much lower ticket rate.
What is the kind of rate that the NBFCs provide funds at for you?
So from NBFCs typically range from 14 all the way to 16 and a half, depending on at what stage they come in. Of course, if you do a construction finance, which we've got recently from some banks, we get it at 10.8% as well.
Have you also looked at the domestic bond markets to tap short-term finance?
We have not examined that aspect, but going forward, definitely, this is a good suggestion. We will examine and assess that aspect also.
Mr. Rajan Thomas, I just wanted to get an idea of how this redeveloped market is growing, because we've seen across Mumbai the spate of redevelopment has started from all the way from town or Kolaba to all the way to Borivali and beyond. It's estimated that over 16,000 projects are underway. So my point is that how big is market for you, and how do you bring in scale in the operation going forward?
So scale can come from, number one, acquiring good properties, getting the consents of tenants in a relatively shorter period, getting approvals fast, and having the required, the funds in place for execution of these sites. So and then also the technical expertise and the technical team has to be there for quick execution and quick turnaround. So, whether I mean, your question is how we escalate? Yes, we have the bandwidth. We have got engineering teams. We will now further augment our engineering teams and get the redevelopment cycle much faster.
Hmm. This net debt, which is currently at 550 crores for you, you're going to pay half of it through your proceeds. My point is that as you bring in more projects, do you plan to raise more equity, or are you going to raise debt capital to finance?
We are okay to raise debt up to 0.5 and not more than 1 in any case of our paid up capital. That's post issue paid up capital. And we are a little debt shy. We don't want to take excessive debt on our books, but we'll try to use a lot of our profit that is generated and redeploy the same as a working capital for our new sites.
You mentioned in the RHP that your inventories are at 634 crores. When do you expect these inventories to be sold off?
We have very good traction, and my son Rahul is looking at sales. I don't do tell them.
In terms of the ongoing portfolio, we expect that to be entirely realized in 2 years. In terms of our upcoming portfolio, like Dad said earlier, we have 16 upcoming projects. So I think that will be realized in the next 4 to 5 years.
So this 635 is sold revenue, if I'm not mistaken. Okay, and then we have unsold a little bit. You're talking about unsold aspect of it?
I'm talking about the inventories which you mentioned in the RHP.
Oh, inventory is fine. Yeah. We'll see. Many of our sites are in advanced stages. Some are in, already completed 2/3, 3/3 of their RCC and things like that. And next 2 years, definitely we see the completion of those sites, by which time we would have sold most of it, and we'll realize those funds also.
And just a clarification on trade receivables for you. It's around 156 crores. Where are these trade receivables coming in from?
So I think these are on account of certain commercial transactions which we've done in terms of receivables from clients as well. So the exact details, of course, I can provide to you shortly. But it's pretty much for the sales which we've done earlier.
So these receivables will be realized in a period of also less, most of it by within the next 1 year, and some the following year.
Gentlemen, it was a pleasure to talk to you today. The Suraj Estate Developers IPO is opening on December 18th, closes on December 28th, price between 340 to 360. It's a fresh issue of 400 crores. It's a central Mumbai-based real estate development company, mainly looking into redevelopment projects and tenant resettlements. That IPO is opening on, as I said, December 18th. Thank you very much for joining us on NDTV Profit and coming on IPO Adda.